right. Hello, everyone, and welcome to today's webinar, Secure Act 2.0. We hope 2023 is treating you well thus far. Joined here by Patrick from our office.
Morning. I felt like Johann was about to say what number webinar this was and then blanked. I don't know what number it is. I think we're in the 20s.
There's been a lot of them.
Yeah, you're looking at the IT guy. If you have any difficulties hearing anything, your screen cuts out, shoot a quick email to info@oceansideadvisors.com. I'll be keeping an eye on that throughout the webinar. And then down below, you should see a little Q&A button. Any questions that come up throughout the webinar, feel free to toss them in there, and we'll chew through a couple of those at the end.
Perfect. Yeah, so here we are, Secure Act 2.0, and I don't know, it feels like for the first handful of years in my career, there was no meaningful tax and retirement planning legislation, and then here in the last 4 to 5 years, we've had Tax Cuts and Jobs Act, then we had Secure Act, well, the original Secure Act, then we had the CARES Act, right, during the COVID pandemic. And now here we are, Secure Act 2.0, meaningful legislation, really all four pieces of legislation. And I guess it's one of the things that makes our job really fun. And, for nerds like us, learning new things and strategies to try to help the people we serve best. And, I think important to point out, well, actually, first, before we get into that, I better read this disclaimer before the lawyers get mad at me. Through this webinar, Oceanside Advisors does not render or offer to render personalized investment or tax advice. Information provided is for educational purposes only and does not constitute financial, tax, or legal advice. Okay, so our goal today, of course, we're going to be walking through the Secure Act 2.0, the changes, opportunities created through the act, but really, really important for me to note that what we're presenting today is by no means exhaustive. Really, we're only sharing, just for the purpose of time, we're really only showing some of the highlights that we think will be most relevant to people. There are just in Secure Act 2.0 alone, there are over 100 different provisions that involve taxes and retirement planning. Okay, so you just want to point out, like, if you're a client of ours, we have spring reviews coming up here in the next month or two, and so we'll be going through each and every one of these changes that might pertain to you and your unique financial plan. So today's definitely just some highlights, kind of the 30,000-foot view of what you'll see a lot of people talking about, and like the main points you're going to want to grasp, right? So we're going to start with what did not change. Okay, I think it's important people understand what did not change. Okay, that there were a handful of pieces in the legislation that didn't make it to the final bill. Okay, so we want everyone to understand what did not change. Then we will walk through what did change. Important reminder, as we go through some of the changes, remember to keep a close eye on the dates that the changes go into effect. All right, some parts of the legislation are effective today, like immediately. Other parts don't start until 2024. 2025, some even further out than that, but just keep a really close eye on the dates. And then, as Patrick mentioned, we'll try to get a couple questions in at the very end. So you can type those questions in anytime, kind of throughout the webinar, and we'll try to get to a few of those at the end. If we don't have time to get to your question, as always, we'll email you back a response later this week. All right. All right, so again, we're going to start with what Secure Act 2.0 did not change. All right, so really nice. So the use of backdoor Roth contributions did not get eliminated. All right, so this has been in the bill a couple times and thrown out. The last couple of pieces of legislation that there was concerns that this might get thrown out, but the law has passed and we can still use backdoor Roth contributions. All right, so many of you know we use backdoor Roth contributions for many of our high income earners. All right, people working who have income too high to contribute directly to the Roth IRA. So therefore, we make a non-deductible contribution to a traditional IRA. Therefore, you have basis, and then we convert it over to the Roth side, completely legal, and it remains legal. So we were happy to see that does not change. Another really nice thing that did not change, they did not place new limits on who can make Roth conversions. All right, there was some concern that that they may have put in a piece, stating something like, if you earn above $100,000 or $200,000 of income, you're not allowed to make Roth conversions. All right, so that also did not find its way into the final bill, which is great, especially for proactive tax planners. A lot of the people we serve want to, they try to minimize their lifetime tax bill to the IRS. So Roth conversions is a very really big strategy in our office here, kind of looking very long term. So no new limits on that. Also really nice, they did not change the age required to make qualified charitable distributions. Another tax planning strategy, qualified charitable distributions, of course, once you turn age 70 and a half, you are permitted to write checks directly out of your IRA to qualified charities. And therefore, those distributions out of your IRA are not taxable. And they also count towards your RMD, right? So we say it a lot, kind of killing two birds with one stone. Really nice strategy. And there was some concern they might increase that QCD age up to the new RMD ages, which we'll get to, but they did not. So that's a net positive that they kept QCDs at 70 and a half. All right. One thing they did not change that we're all still a little bit baffled by, we were hoping we'd have more clarity on the manner in which the new, the 10-year rule created by the original Secure Act in terms of inheriting IRA accounts. If you inherit those IRA accounts after the account owner had reached RMD age, how much we're supposed to take out, in those 10 years. Okay, like per year. So we're still waiting on that clarification. So we were kind of hoping we'd have that here. We do not, unfortunately. So just a quick list of the in my mind, some of the main things that were not in the bill. So definitely let us know if you have questions on those. All right, so transitioning into what did change. All right, the big one that I'm sure everyone's heard about to some extent is the required minimum distribution age has been pushed back again. All right, it was going back a ways. It was obviously the RMD age was 70 and a half for a very long time. Okay, and then obviously that got pushed up to 72, and now we're going further up here. All right, so importantly, it's just a nice starting point. If you have already started required minimum distributions, nothing changes. All right, so if you turned 72 last year in 2022, you would have been required to take a required minimum distribution, as would everyone else that had their own personal retirement accounts that was born before then. All right, so if you have already started your RMDs effective December 31st of last year, nothing changes. All right, so same tables, you keep on taking that distribution into 2023. However, if you are turning age 73 between the years 2023 this year and 2032, your RMD is now pushed back to age 73. All right, so an extra year, they're going to push that out, And then for some of our younger professionals, if you are turning age 73 in the year 2033 or after, your RMD has been pushed back to age 75. Another way to look at it, if you just want to look at birth year in terms of the table here, again, if you're born in 1951, I'm sorry, but before 1951, Impact of Secure Act 2.0 is nothing. Again, you're still going to take RMDs as you have done. If you were born between 1951 and 1959, RMD pushed back to age 73. And then if you were born in 1960 or after that date, your RMD is pushed back to age 75. Okay, a couple other little pieces that pertain to RMDs. The penalty for missing an RMD. All right, we've said it in the past. It was 50%. All right, so like the most strict, the worst penalty in the whole tax code. It was 50% for missing an RMD. That's been reduced to 25. Okay, and even better yet, this penalty is reduced to 10% if fixed during what they call the correction window, which I saw a big long list of what that. I haven't dug into the correction window, but I'm sure it'll be some reasonable amount of time. If you spot the mistake, you fix it. Penalty reduced, from 50 really all the way down to 10, as long as you're paying attention. If you're really paying attention, you shouldn't have any penalty. But seeing that penalty reduced is nice. Again, just want to make the point, like RMDs are still required for owners of inherited IRA accounts. All right, so and this, it gets a little bit tricky, and this is why it's I just want to be really careful when we discuss inherited RMDs on a webinar like this, because you have people that inherited accounts pre the original Secure Act, which you have a table, a lifetime table, the so-called stretch IRA, different set of rules for individuals, post Secure Act inheriting accounts. But if you were had an inherited IRA, these changes would not apply, okay, to 2023 and so forth based on your age. So just want to make sure everyone knows if you inherited account, kind of different set of rules. So be careful there. Kind of funny that the way this works out, just given the way they pushed back the RMD. So again, if you were already taking RMD, no change. Okay, but the way the dates play out, if you were not taking an RMD, right, there's going to be nobody in the year 2023 that is required to start new RMDs. All right, so now of course, in terms of your IRA monies, as long as you're 59 and a half years old, you always have access to that money. But in terms of the IRS forcing your hand, forcing distributions, no new account owners in 2023 are forced to start RMDs. Okay, so for those who can afford to wait, obviously this is creating an additional window that you're able to utilize for planning purposes. Definitely some further need for proactive planning. Things like conversions, and I could put a big list here, things like realizing capital gains in lower tax brackets. And it does create, one thing we talk about a lot, people that do not proactively plan, so maybe more reactive planning. You are kind of setting yourself up as RMDs are extended for, whenever you start RMDs, the RMD is now going to be higher, and you combine that with Social Security, and you just want to be careful long term that your tax liability, whether it's 5 years from now, 10 years from now, 15 years from now, that you can kind of see what's coming, what some people call the big tax crunch at some point in the future. All right. Okay, transitioning from RMDs. All right, another nice little addition here is now Roth Simple and Roth SEP IRAs are now permitted. Okay, in the past this was not the case. You could only contribute in a pre-tax manner. All right, so Roth Simple, Roth SEP IRA. However, in practice, this will likely take a while to implement. We've heard from a number of the major providers that offer, in particular, simple IRAs. They say this is going to take many months to roll out and get everything in a place where they can start opening Roth Simple, Roth SEP IRAs. So, and again, still kind of waiting on some guidance, some further guidance from the IRS. Of course, employers have to adopt and provide guidance as well. But just neat that they're now going to be permitted. Important to note, and this is just kind of Roth versus traditional 101, but any deferral into a Roth Simple or Roth SEP IRA, obviously that income is going to be included in gross income. So you just want to be aware of that. And also, interestingly, another kind of neat point, employers are now eligible to, so they're matching contributions, okay, or sometimes non-elective is also eligible for Roth as well. All right, so, and we're going to add a little bit on this later on, for 401ks, 403bs as well. So employer contributions also eligible for Roth. Okay. Now you'll note here, again, and why we really need to pay attention to the dates. So effective 2024, all right, so not this year, next year, high wage earners are going to be required to use their Roth part for catch-up contributions in qualified retirement plans. All right, so as it stands now, 401k, 403b, anyone can contribute entirely to pre-tax to try to lower their tax bill, right? So you could contribute your whole contribution and your catch-up contribution. You could do all pre-tax. Okay, so starting 2024, the way the legislation reads, if wages from the plan sponsor in the previous year, right? So they're going to use 2023's wages to determine the way your 2024 catch-up contribution will need to be contributed. So wages from plan sponsor in the previous year are greater than 145,000. The employee is required to use Roth for their catch-up contribution portion. All right, so looking at 2023 IRS maximum contribution. So like the regular contribution is currently $22,500. So like you would still be able to do that first $22,500 into pre-tax 401k or 403b. But this last, what they call the catch-up contribution, which is currently $7,500, where previously you were able to put the entire amount, right? So this year, $30,000, you could do all pre-tax. We're starting next year for high wage earners, as defined as 145,000 of income. That last 7,500 is going to have to be put into the Roth bucket of the 401k or 403b. Okay, just an interesting point that I thought was worth bringing up. This requirement is based upon wages in the previous year from the current plan sponsor, which appears to imply that a high wage earner, okay, if you start a new job, you may still be eligible to contribute catch-up contributions to the pre-tax account for that first year you'd be at the new job, right? So, right, if you're starting a new job, that in theory, that employer would not know what you earned the previous year, right? So there may be a slight little loophole here where if you are a high income earner and you're doing everything you can to defer income for that year, maybe a little workaround here for a year if you want to defer income and you're starting a new job. So just something to keep an eye on for that. Effective 2025. All right, so again, a couple of years from now, 2025, they've opened up basically kind of like an increased catch-up contribution. for a handful of years right before you retire. Okay, so well, I think that's the intent of the legislation is, yeah, if you feel like you're a little bit far, maybe not where you want to be from a retirement standpoint, yeah, let's increase that catch-up contribution. Just open that limit up a little bit more. Again, as I mentioned on the last slide, that catch-up contribution limit, as it stands today, is $7,500 for the year 2023. Whereas in the years the taxpayers turning 60, 61, 62, and 63, this catch-up, the new catch-up contribution effective 2025 will be limited to $10,000, or straight out of legislation, any amount equal to 150% of the dollar amount which would be in effect under such clause for 2024 for eligible participants not described in the parenthetical in such clause. Okay, so to kind of quantify that, if you look at 150% of the 2023 catch-up contribution, that would shake out to a little over 11,000. So what it looks like in practice, the way this will likely play out, and we won't know for sure again until 2025, but it looks like that catch-up contribution, instead of being today, which is 7,500, might be closer in that 10 to 12,000 range. So maybe an extra $4,000 to $5,000 that a participant could additional deferrals that they could make into a plan to try to help for retirement. All right. Also, just wanted to point out similar provision in simple IRAs as well for catch-up contributions. For taxpayers in the early 60 years as well. I believe it's 5,000 off the top of my head. Okay, this next one's gaining. Let me get a sip of water. All right, so when we first saw this, I got really excited. All right, now effective 2024, 529 plan to Roth IRA transfers. So when we first heard about this, I got really, really excited. It's still kind of neat, but once I started reading through some of the restrictions, we became less excited. We were talking a lot about this in the office, but the way this works, okay, so you can transfer a 529 plan, right? So basically what's kind of earmarked for college savings or for college tuition, things like that. We have a lot of clients that have 529s open for their kids or grandkids. And one of the concerns is, hey, what if my kid or grandchild doesn't go to school or does something else, and now I have this 529 plan? Well, Congress has addressed this with now this new provision effective in 2024. You are permitted to transfer some 529 plan to Roth IRAs if you follow a lot of rules. All right, so bullet number one, the Roth IRA must be titled in the same name as the 529 plan. Okay, so same beneficiary essentially. The 529 plan must have been maintained for at least 15 years. Okay, so in other words, it's got to be sitting there for a while, right? So when I saw that, it's like, ooh, that's a lot. But okay, so the 529 has to be maintained for at least 15 years. It's still unclear, how a change in beneficiary will be treated. Okay. And again, that's why we're still waiting on a lot of clarification and guidance from the IRS. But you need to hold it for 15 years. Got to be the same beneficiary. Another thing to be aware of: any 529 contribution within the last 5 years cannot be transferred to a Roth. All right, so not only is it a 15-year clock once you open the 529, but also any contributions within the last 5 years cannot be transferred to the Roth. Transfers are subject to IRA contribution limits, less any regular IRA or Roth IRA contributions, right? So the way it stands today, if you're younger than 50, so for the 2023 year, the most you can contribute to a Roth IRA would be $6,500, right? So in a sense, if somebody already had a 529 open for 15 years and they wanted to do this today, the most they could contribute would be 6,500 for this year, right? Into transfer over to the Roth IRA. The beneficiary must have compensation, right? So that's an IRA rule, right? To get money into the IRA, you must have some kind of earned income. So the same applies if you're trying to transfer from the 529 into the IRA. And then lastly, there is a maximum $35,000 lifetime transfer to a beneficiary, right? So over time, again, because you have to abide by the annual IRA contribution limits. Like obviously, this is going to take a handful of years before you could get to that maximum $35,000 lifetime transfer limit. So I'm sure we'll have questions on that. Like again, we were really excited at first, and there's just some restrictions. It's one of those provisions where it's, is it worth opening up a new 529 just because of this provision? Like, I don't know, maybe not. But if you already have a 529, right, if the intent is to help pay for a grandchild or a son or daughter's education, and this is just an extra provision, obviously a net positive.
Yeah,
Patrick?
I think like just looking at, and this is like you summarizing the list of provisions as concisely as you could. I think looking at what the IRS and / Congress, like what they came up with here, it's pretty clear that they want, if you have 529 money left over in a 529, to be able to do something with it. They're trying to avoid the sleazy move of planning 15 years in advance to fund a 529 that isn't going to go for a kid's college. And I think it's pretty obvious with these restrictions. So it's, I know you and I were pretty excited when 529 to Roth IRA transfer when we heard those words, but in practice, it's going to be good for the few $1,000 you might have left in a 529. But starting a 529 that you have to hold for 15 years, I think it was Levine.
Yeah.
Final answer. He made the point that anything that you're planning on doing 15 years from now, based on something that Congress decided on, is probably not the best planning strategy. And I think he's right on that front. So neat, but not as neat as we would like.
Yep. Okay. And then kind of the last slide and biggest picture, the biggest point on this last slide is, and there are so many provisions related to this, but stated in a simple sentence, that there is now enhanced access to retirement funds in times of need. Okay, so and again, there's other restrictions and caveats on all these, but $1,000 penalty-free emergency withdrawals, right? And so getting out of that 10% premature withdrawal penalty, that the penalty that you're assessed if withdrawing from accounts younger than age 59 and a half, terminal illness distributions, age 50 exceptions for public safety workers. Also, that there are new income exclusions for disabled first responders, which I'm sure we all think that's a really good idea. Qualified disaster recovery distributions. They've also expanded plan loans in disaster areas, right? So if there are hurricanes or tornadoes, whatever that might be. Distributions for domestic abuse victims, qualified long-term care distributions, easier to get retirement funds for that. Also, the relaxation of 72T rules. I know, Patrick, you help a handful of clients in this space.
Yeah, the 72T payments are extremely complicated, but to try and summarize them, it's a way that you can access IRA money pre 59 and a half without penalty. very short explanation is that you need at least a 5-year window basically before 59.5. You can run further than that if you start at 57, for example. But basically it's a set period of time that you have to take a certain amount out of your IRA once you start doing it to avoid penalty. They kind of eased up on some of the finer details of these, because if what ends up happening is if you get 4 years into it and you make a mistake, or you forget to take the distribution, or you take less than you were supposed to or more than you were supposed to, they're very particular about it. They'll come back and claw back the penalty for last year, the year before, the year before that, the year before that, which can end up being a huge tax bill. So they kind of lessened some of the finer details of those 72T payments, which applies to those that already started them, which is nice.
Yeah. Okay, perfect. And yeah, just before we dive into some questions here, feel free to write them in. Yeah, I think just a couple points, just really big picture. Roths, it's very, very clear, like Roths are here to stay. Okay, just the way the momentum that legislation's been pointing, by not limiting Roth conversions, by kind of forcing some other distributions, catch-up contributions into Roth, allowing the simple Roth, the simple SEP IRA, these 529 to Roth transfers. It's just that there are so many. It's just a lot of different pieces of legislation that are pointing that Roths are here to stay, and it makes sense. Like taxpayers, we like Roths, right? It provides additional flexibility in retirement, right, to pull from different buckets for tax planning, and from the IRS, from the government's perspective, like they're not opposed to Roth either, right? Because that means they are getting more tax, that they're collecting more taxes today, right? So I thought that was just kind of, it just seems more and more legislation is pointed that way, where they're encouraging Roth, and I think it's just important as taxpayers and planning retirements, that you kind of understand that direction, and you consciously and intentionally plan, right? Proactively plan, knowing that, and that kind of ties into my second takeaway. Like this legislation, it just increases the need for proactive tax planning. I think the people that unfortunately will get hurt the most here with this legislation are those that are more reactionary in their tax planning. All right, so if someone's not making changes, so if they're just kind of living life and not making any changes from their working years into retirement, kind of that tax crunch, kind of, we call it like a ticking time bomb for taxes, right? Where all of a sudden Social Security hits, and now an RMD hits at age 75. That's much larger. Maybe there's a pension involved, and all of a sudden you're in a much higher tax bracket. Maybe Medicare is more expensive now, your capital gains taxes are more expensive, and I think it really really just shows the importance, now more than ever, just the importance of proactive tax planning. Like when you retire, if you have a couple of years where you're in a lower tax bracket than you have been in the past, we would encourage you to reach out to a CPA or other financial professional that can kind of look very long term, a multi-year tax projection, and try to take advantage of some lower earning years for Roth conversions to kind of help with the lifetime tax bill. So, did I forget anything, Patrick?
I don't think so, but just to kind of piggyback on that, it's obviously it's great that the government isn't requiring you to take money out of your IRAs. They've pushed that age back, but you're really just kicking the can down the road as to when you get hit with your RMD is going to be bigger at that point. It's awesome from a planning standpoint, but if you aren't planning, it's only going to make things worse. It's kind of my feeling. We do have a bunch of good questions. I'm going to start with my favorite question from Johann Kroll. As Johann said, school's off today. When are you coming home, Daddy?
Keegan,
question number
so
one.
sweet. That's fun. So yeah, as I mentioned on the Monday video, or I guess it's Tuesday, but on the video this morning, school's still out here in Charleston County. My daughter wrote in, "When are you coming home today, Daddy?" It's very sweet, Keegan. I think a little earlier than usual. That's what I'm hoping. So should be kind of sometime this afternoon. We'll see you soon.
And that's a good play from Keegan, because now I can transition into if she doesn't use all of her 529, what are our options for her or for you? We got two 529 to Roth questions. Regarding 529 to Roth IRA transfers, does this mean I cannot make the transfer to my daughter's Roth, Keegan's Roth, if she's already funding her own Roth IRA?
Right, that's correct. So remember those transfers into the Roth IRA, right? You have to you have to follow the rule. You can't break the rule that there's a contribution limit in any given year, right? So for this year, that limit's 6,500 that you could move to over to the Roth IRA. So if your son or daughter or grandchild is already super responsible, and maybe they're already contributing to their own Roth IRA, that's correct. You would not be able to move additional money to the Roth if son, daughter, grandchild, whoever is already contributing to that Roth. So really good question. So if they're only contributing for 2023, just hypothetical, if they're contributing 3,500 and there's still 3,000 left in that window, like that would be the amount that you'd be able to transfer over, I should say, into the Roth.
That was Matthew, by the way. We actually have two more. We had another 529 question come in while you were giving that answer, which we'll get to in a sec. From Christopher, does changing the beneficiary on a 529 account restart the 15-year clock?
Do you want to take that one? Because I know you had looked into that a little bit.
Yeah, because the second I heard about the 15-year clock, I got excited because first off, the 15-year clock is when you open and fund a 529 is when it starts. I actually opened, I don't have any kids yet, but I actually opened a 529, I think last summer, because I was trying to explain something to a client on how to get situated, and was like, well, why don't I just log in and make an account for one day when I do have a kid? So I just made myself the custodian and the beneficiary. And at some point we can change that to Patrick Jr. or whoever. But and I started thinking, if I funded my own 529 today with the plan of down the road transferring it into a Roth or contributing to a Roth via it, the way it reads and the way this has been discussed by the people that are much closer to members of Congress than Johann or I am, it sounds like that isn't going to be the case. Like, it won't restart the 15-year clock. We can't say that with certainty. Yeah, I would be very surprised if that was the case, only because, like, we as adults are contributing to kids' 529 accounts to help them through school. You would think, yes, you might want to give your kid money for their retirement, but you also may want to take what's left over if your kid doesn't go to school or doesn't use all of the money to fund your own retirement. So I would think that isn't going to reset the 15-year clock. And the people that are more informed than I am think that as well. But I would say never say never. We'll kind of keep our ears open on that front and see what unfolds. I would also think that with the Secure Act 2.0, we're going to get kind of some more defined terms and some clarification on some of these things in the next 12 months.
And I just saw Jay just sent in a question there as well. So does the 529 to Roth also apply to Coverdell ESA? I didn't see any particular language. Patrick, maybe you did on the Coverdells. What I do know is for a lot of clients, we have transferred Coverdells into 529, so they get the state income tax deduction that Coverdells do not, right? So assuming, like, worst case, you could do this in 2 steps, Jay. You could go Coverdell to 529, wait that 5-year period, and then convert to Roth. But there could be additional language on the Coverdell that I just haven't seen yet. Again, it's thousands of pages. Have you seen anything on that, Patrick? The Coverdell to
I haven't, and when I saw Jay's question come in, I was thinking exactly what you did, which is you could just send it into a 529 and wait it out at that point.
Yeah.
No, I haven't seen anything on that front. 2 more questions here. We got Susan asking, do I have to take an inherited Roth IRA RMD this year?
So the answers to that question is no. All right. So the way inherited Roth IRAs work, okay, and again, this is, it's so particular, so specific to individual cases, but the way the Secure Act, the way it reads with the 10-year rule, it's if you inherited it. Let me back up. If the original account owner had not yet started RMDs, okay, you do not have an RMD in each of those 10 years, right? So given Roth IRAs in general, okay, don't have RMDs for the account owner's lifetime. So that implies that the account that you're inheriting does not, would mean you would not have to take an RMD from an inherited account, assuming this Roth account was inherited post Secure Act 1.0. That would just mean within the 10-year period, you just need to have that balance withdrawn. So the answer, Susan, would be no, not for this particular year, but just be cognizant of the 10-year rule and making sure you get those funds withdrawn within that 10-year window. Which, by the way, for most people, you'd want to wait to the end, right? Because that money's growing tax deferred for the when it's tax free, really. Good question, Susan.
Last question here from Art. Do employers who change their matching contribution to Roth still receive the tax deduction?
Good question. Yeah, yes, they do. Right. So I know it was like a little sub bullet, maybe halfway through the slides today, but the way it is worked for a long time, right? So you contribute to a 401k. If you have an employer that's kind enough to match, it might be 4% or 5%, like that's always gone pre-tax. And as the employer, you receive the tax deduction for matching that deduction, or matching the contribution. As the employer, you get to deduct that. If that matching contribution is now, if they decide to do post-tax right into your Roth bucket, yes, that is still, they would still receive that deduction, right? Because that's money the employer is giving to you, so off their books. So yes. And again, that I can't remember. I think that might not be effective till 2024. Not certain on that.
We got one more that just came in from Kathy, and she amended her original question. Oh, a couple more. Oh, no, that's just a compliment. Thanks, Pat. From Kathy, do I have to take an RMD from a traditional IRA in 2023?
Yeah, so from an inherited traditional, I assume is.
So oh, hold on. She said, yes. I don't know if that was in response to what you just said.
Yeah, so And again, that this is, and I think what Kathy's asking is the point that they still haven't provided guidance on. So Kathy, if you are asking, if you inherited a traditional IRA account, post Secure Act, 1.0, meaning you're subject to the 10-year rule, and the account owner that you inherited the IRA account from, when they passed, if they were of age where they were personally required to take RMDs, okay. The way this is what we were really hoping this would be clear, and it's not yet. What we do know is in 2021 and 2022, you were not required. For a while it looked like you were, and then they said no, because we haven't figured this out, you're not required. But starting in 2023, they said that it seems likely that you will have to take at least some RMD from an inherited, traditional IRA over the next handful of years within that 10-year period, right? So you'll still need to take the whole balance within the 10-year window. But what's unique to traditional IRAs is there's also an additional kind of required amount that you will likely need to take out. Unfortunately, they still haven't given guidance on this. And in fact, all we've heard that it says is we will provide guidance. What was the word they used? At the earliest 2023, I think is what they said, at the earliest 2023. So we don't know, Kathy, but it's definitely, it impacts a number of our clients that have inherited accounts the last handful of years. And so it's something that we are keeping a really close eye on. And I'm sure like in my Monday videos, as soon as we hear something or receive any kind of clarification, that's something that we will share. So good. I see a handful of others here coming in, but yeah, I think we could probably just respond to some of these via email later on. So with that, we want to thank everyone for joining us today. Hopefully this has been informative and helpful. Again, we would strongly encourage you to seek tax and other guidance from professionals that are have a better understanding of your unique retirement plan. So obviously we're happy to help if and for our clients and many clients that are on the call here today, which is fun. As I mentioned early in the presentation, we'll be going over a lot of this with you. Even some of the less relevant parts, right? So again, there's 100 moving parts here. So we'll tackle a lot of those in the spring reviews. We're really excited to see everyone. Gosh, spring reviews are like 6 weeks away now. So
yeah,
we'll
6 weeks from yesterday.
That'll be fun. But thank you for joining us. And again, feel free to write in a question after the fact here, info@oceansideadvisors.com. And we would be happy to try to provide you with what we know today. So we hope everyone has a great week, and we'll talk to you soon. Thanks.